Welcome to EWA's FIN LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everyone. Today I'm joined with Jamison, and we're going to be talking about what to do if interest rates start dropping. Are there proactive moves you can make in the context of your financial plan to put yourself in a better position? So, Jamison, give us a history of like what historically have rates been? What are average? What's high? What's low? What's average? What's high?
Yeah. So if we look at history, right now interest rates are 6-7%. They seem really high. If we look back 2020, interest rates were in the 2 to 3%. That's really low. Historically, the average is about 4 to 5% range. So we're not too far off of that. I think there's a kind of a skewed bias from because of the COVID pandemic with how low interest rates were. People think that that's normal, and that's like, I guess, abnormally low. So if we look back at history, keep this really, really simple. Basically, the Federal Reserve was established in 1913. Federal Reserve dictates the interest rates based on what's going on in the economy. If the economy is moving too fast, essentially, they'll raise interest rates. If it's slowing down, they'll lower interest rates. And so in times of any time of like economic uncertainty, depression, recession, generally rates drop. Anytime that the opposite happens, rates rise. So Great Depression, obviously, interest rates were cut sharply. And then post-World War II, interest rates remain low, help spur some economic growth. And then really the next big event was really in the 70s and the 80s. So high inflation, interest rates started to rise. And at that time, interest rates peaked at like 20%. So that's like pretty hard to even wrap your head around. If you're going to get a mortgage and it's 20%.
Yeah, you're also getting 20% in a CD then too, right?
Yeah. So there's a
little bit less.
There's some positives, yeah.
Yeah.
And then since then, obviously they've come down, and then like I said, in 2020 with the pandemic, rates dropped drastically. So since 2022 to 2024, rates have gone up, and now we're on this like. It's really the talk of the, if you look at any headlines right now, it's like what's going to happen in September with the interest rates. And I think it's maybe given a little bit too much of a headline, too much focus, that people think that's going to like dictate the whole economy.
Yeah, let's look at where we are today. So thanks for that background, Jamison. So we're going to put the slide up for those that are watching on YouTube or the Spotify video. So this chart shows 2004, 2020, and 2024. So this, U.S. government bonds in 2004 paying 2.87%. In 2020, 0.58%. In 2024, 4.43%. So we're in decade level highs here. And if we go to like U.S. high yield bonds over here on the right, 7%, 7.2% in 2004, 9.44% in March of 2020, and now March 2024, 7.66. So everything but high yield bonds here, essentially 2024, the interest rates are at decade level highs. So our tips with what to do if interest rates are high and they're going to start dropping. Now we can't say that for certain because interest rates could continue to stay where they're at. They could continue to climb. And that's all based upon the Fed, what the Fed decides to do. If inflation were to kick back in, they're going to keep them high. They may even raise them. However, under the hypothesis that we are under, high rates, and the Fed has come out and said we're probably going to have some rate cuts, what are the best things to do? And this really boils down for us as financial planners as three things. So the first thing is easy. Look at all your debt, and Jamison, walk us through that.
Yeah, really refinance debt if it makes sense. So if you took out a mortgage in 2023 at 7%, and rates start to go down in the next year or two, and you can refinance to 4%, usually there's pretty significant savings. Any type of loan, if you have an opportunity to get a lower rate and save your monthly payment, save the amount you're paying towards the loan, could make sense. You got to be aware of there's generally costs to refinance, there's loan costs, so it has to be enough of a difference to make up for that.
Absolutely. And there's closing costs involved with that as well. So you have to, if you're going to, at least with like a mortgage, if you're going to move in 2 years anyways, you have to evaluate, does the closing cost make sense?
Yeah.
For the interest saved, and it maybe not. And people move like 9 to 10 times in America. So the other thing you have to consider is paying, thousands of dollars to refinance make sense if I'm going to end up moving? Is the interest saved over that period before I move going to be more than the closing cost itself, or the investment opportunity on that money up front?
Yeah, and then I would say any type of debt, car loan, anything you have at all could be.
The exception is really around your federal school loans. If you're in some kind of forgiveness plan, then you don't want to touch those. If you refinance to a private loan, then you lose your chance for forgiveness. But everything else, what's the cost to refinance, and then ideally the lowest interest rate, the better. We find banks typically push ARMs where in 7 years, 5 years, 7 years, interest rates can fluctuate. Those that did that 7 years ago locked in ARM for maybe 2.5%, and now it's coming due at 7%. Not a good decision. So we typically recommend with long-term decisions like that, do a fixed rate. You're going to pay a little bit more, but you're going to have the certainty where you're not going to get hit. And that's a big reason why the commercial real estate in America, especially like Pittsburgh, for example, is under a lot of pressure. A lot of banks are taking over the buildings because people are, or they're going into foreclosure or receivership, or it's bad decision making up front, or greedy decision making, trying to save a little bit of money.
And I think I've seen ARMs being pitched heavily right now because rates are high. People are anticipating they're going to drop, so that the pitch is, if rates drop, you're gonna within 7 years we'll be at a lower rate. But the reality is nobody has any idea what rates are going to be in 5, 7, or 10 years. So a lot of times there's just a lot of risk to try to do that. And one of the things to be aware of is if you're not putting a significant down payment down. So let's say you're doing a physician loan with nothing down, and you're trying to get into an ARM, you could run into problems where you don't have you're going to need like 20% equity to refinance the mortgage anyway. So if the house doesn't appreciate, if you're in a spot where the house doesn't appreciate or even maintains value, and the term of, let's say you did a 5-year ARM and the term of the ARM's coming up and you don't have that equity, you could be underwater in the house and be in a lot of trouble.
Be in trouble, big trouble. Yeah. So today reminds me of back in March of 2001. So right now, if you throw your money in a money market right now, it's paying about 5%. Right, I think Fidelity 4.97 at Fidelity. Just as an example. So March 2001, money markets were paying 5.8%, and then rates started to get cut. So if you go to March 2002, on the slide, money markets were paying 2.6%. So your yield would have got cut by 3.2% in 12 months, and then one more year, July of 2002, you were down to 1.8%. So the point is, if you go on any bank and say, I want a 1-year CD, they're going to pay 5 right now. You want a 5-year CD, it's going to be under 2 with most banks. And the reason for that is most big banks that talk to have direct access, they know interest rates are probably going to go down, and they don't want to lock in that long period. Well, the government hasn't decided this yet, so that's why you can go in like a 10-year treasury right now and lock over 4% in. So tip number 2 would be managing cash. If you have a lot of cash on the sidelines, you want to keep it on cash, think about locking in a higher interest rate for a longer period of time. So, as an example, if you have $100,000 in cash and that's just an emergency fund, you want to keep some of that liquid. Maybe you keep $50,000 or 6 months of expenses, but if you want some sleep well at night, you may want to put something that, like a 10-year treasury, where it's going to pay you that 4%. If your $50,000 that's paying 5 drops to 1 next year, you're going to be pretty upset. Well, the other half, maybe you lock in at 4, and you have that guaranteed for the next 10 years. Now, the downside of that, if interest rates continue to climb, you're still going to get your 4% and it's safe over 10 years. But if you try to sell it off before the 10 years, you'd have to accept a little bit less because no one's going to buy your 4% if a 5% bond is available. On the flip side, if interest rates do drop, not only are you locking in that 4%, but you could actually then go sell that bond if rates are now 3. Everyone's going to want your 4, so they're going to have to pay you above what you paid for it to get that. So a lot of clients are working on repositioning cash, and our portfolios in general, like we historically been about a 5-year duration with our fixed income. We're very equity, centric investors here at EWA. But for those retired clients that we need to have that guardrail, that safe money, so no matter what happens in the market, you're still able to live your life by design. This brings us to tip number 3 is evaluating your investment portfolios. You want to have really a layered strategy when it comes to your interest rates and bonds. And so just an example, in our portfolio, we've extended the duration now. What was below 5 years is now approaching close to 6 years because lock in these high rates. But we have 1 to 2 years in the short term. So in 2022, when bonds lost 14 or 15%, you didn't lose money unless you sold it. But if you had to sell it during 2022 and that was your safe money, was a 5-year bond and that's all you had, you'd have had to take a 14% haircut on most bonds that year. So we still need to have some short-term availability, and that's why we have a layered bond strategy. So if the market's down and interest rates are fluctuating, you can still have safe money. But then, part of that 6-year duration is made up of, 10 to 20 year treasury overlay, where we have, if interest rates do drop, we've locked in interest rates for a longer period of time. So that's our third tip, is really evaluating your investment portfolio and making sure you're not asleep at the wheel and taking advantage of locking in some of these higher interest rates before they drop.
Yeah. And I would say I've seen clients obsess over this a little bit too much, meaning the purpose of any type of safe money is to have it available and liquid when you need it.
Yeah.
So our philosophy is we want to hold anything, bonds, cash, treasuries, money market, whatever, for financial planning purposes. So if you have a purchase in the next, couple of years, we don't need to put it in equities. If you're getting ready to retire or you're in retirement, we have that 7-year safety net. Obviously, we want that safe and liquid. But I've seen people obsess over, I could get a 4% rate here or a 5% rate here. And at the end of the day, we want to try to get the highest return we can on something safe that we're holding, but we just want it to be liquid. And that 1% is really not gonna be material for your financial plan.
Well, that's our tips. Reach out if you have any questions. If interest rates drop, make sure you're in the position to take advantage. If they don't drop, also make sure your financial plan is able to withstand whatever changes happen in the Fed policy moving forward. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.